Hello, everyone. Welcome, welcome, welcome. We are so excited to have Ryan Yates with us today, who is going to talk about one-offs, real estate one-offs, which is if you have a industrial, let's say an industrial complex, and you brought that to us, we do all the due diligence on it, or they bring a fund, $100 million fund, so they could go out and buy 10 industrial complexes. So he's going to talk about the two of that and his authorization, basically, that you would say that he can do this is because he's got he's the founder of Cardinal. He works with the funds and helps create the funds. He works in operations. He does accounting. He does quite a few things. I had it up. I shut it down, so can't see it all. So he founded this company, and besides working in that, he works with some of the big guys as a fund administrator for like Citibank, Morgan Stanley, a few others. And what he really is working in is accounting and operations. For those who are really fans of cryptocurrency, he's in that element also. He works in the hedge fund world, the PE and real estate firms prior to forming this company. And he also holds the current role of Vice President of Finance and Compliance of Veloci. Is that how you say that? Veloci Capital. So today we have Ryan Yates with us. So Ryan, take it away. Thank you. Everyone, here is Ryan Yates from Cardinal Financial Consulting.
Thank you, everyone, for your patience. Technology hasn't been my thing today, apparently, for 15 minutes now. Thank you, Peggy, for the introduction. As Peggy said, I worked for some of the bigger fund admins over the past 15 years, State Street, Citibank, Morgan Stanley. Accounting, operations, investor servicing, hit just about every group. And, my background is starting funds. I started in hedge. I've moved over to private equity and real estate. And as Peggy said, I even go into the crypto world. I've spent my whole life in this industry. And I take a little more ownership towards the real estate markets because I've worked in it. I've worked as a construction guy. Worked for a family business and, worked on the real estate side from funds as big as BlackRock. My goal is to help people start funds. And of course, you can have a standalone fund like a syndication, or you can get for lack of a better term, blind funds. I've never been a fan of that terminology, but it is kind of what they describe. In the hedge fund world, it's not a blind fund, but in real estate, it kind of is, because you're raising this money for deals that you might not have at the ready. So I created this little presentation to kind of walk you guys through, the steps. And the steps are very similar. And depending on how the structures that you want to structure these deals, there's many different options that you have.
And remember, you used up 10 minutes already of your 20-minute time. We'll give you a little extra.
No, it's okay. I can do this. I know I can. So, overall fund setup's about the same. So you still have to go through the legal documents, but with a fund, you do have a couple of added, steps that you kind of want to go through. If you're a standalone, you're doing one deal on a syndication, everyone's going to do their due diligence on you. You're going to have your legal documents set up. There's a good chance that you might have a platform that you're raising capital on or just running everything through. And you really don't need, for lack of a better term, a full set of books and records done by an independent third party. But when you're dealing with a fund, that's kind of the direction you go in, because you want that level of compliance. You want that level of safety, knowing that if they're going to split the money between 10 deals, you want to make sure that everything's being handled correctly. If you're going through a fund, you're going to do a little bit more, where you have third-party fund administration. You might have an audit depending on the setup, and then you have your operating platforms to make sure that the fund admin is going in the right direction. We'll go through this real quick. The first thing, the difference between a syndication, which of course is one deal. You might have that one level of due diligence. You may have a pitch deck. You're raising to one deal. When you're working with a fund, you want a term sheet, and that's mainly what you put together first before you go into this, because you want a fact sheet about your fund structure. Key members, fund terminology, fund term, liquidity, redemption strategies. Description is the investment strategy. Do you want to just invest in, like you said earlier, 10 industrial sites for $10 million each, or do you want to diversify? Putting the term sheet together gives you a little more structure when you go to spin off your PPM, which is going to be private placement memorandum, which is going to be, the bigger portion of what you're looking to offer. Of course, other things you're going to include in there: fee structures, reporting requirements, and then of course, this will change, especially when you deal with someone, such as myself, when you go through the first time and you realize that, everyone does hurdles, but a hurdle might not work for what you want. Or if the lockup periods are set, everybody wants that 5 to 10 year fund, it may have to be 15 years. It depends on how the structure is and whether it's open or closed. And there's a whole bunch of other, factors that'll be worked into that. Of course, legal documentation is going to be a little bit, more robust. Most syndications won't have a CPM, but with a fund you would. Operating agreement, of course, if you're working on a joint venture or basically any structure, you're going to have an operating agreement with that as long as GP's invested. The limited partnership agreement is basically going to be the same thing. Sometimes there's a subscription agreement that's separate from that, and then of course your redemption and transfer agreements, especially in a fund when you're looking at a longer period than just one deal. I've seen transfers come up in standalone syndications, but you do want to make sure that you have those documents ready. Operations and day-to-day, of course, with a standalone syndication, I'll tell you right now that I run 3 of them for Veloce Capital. It's a monthly reporting requirement, basically. There's a preferred return that we paid out. So, I do wires once a quarter. That's about it. Very straightforward. We do have tax time come around where we have to make sure that the tax documents are in order. But syndications basically run themselves. There's people who charge management fees. There's people who only charge performance fees on it. It kind of, it's definitely a simplified procedure, especially as you go to launch. When you get to the day-to-day operations for something that's slightly bigger, you have hedge funds which are daily and weekly because you're dealing with liquid markets. PE, real estate, and venture capital are actually very similar, and especially when you go towards the blind pools, as we'll continue to call them, where you might only look at it monthly or quarterly, depending on how it's structured, of course. From my point of view, and being an advisor, I try to keep tabs on everything within a weekly to monthly basis just to make sure everything's going in the right direction. And then, of course, as you have, 5 to 10 deals, you want to make sure everything's in line. You want to make sure that the cash is flowing correctly, and that's where we do leverage third parties more than anything else. Fund admins are huge in this space. A lot of people claim to be fund admins depending on where you're looking to, reach out to. There's a lot of syndication / these smaller places that call themselves fund admins, but when I look for a fund admin, I do look for like a SOC 1 audit, which basically is a compliance audit on their processes and procedures, which kind of gives them, it gives you and them a little more comfort dealing with cash management, where they will handle most of the cash management but get sign off from the operations teams at the funds. And, they make sure that they can KYC AML on your investors. They make sure everything's in line. And they really are your books and records. So they'll handle everything from subscription documents, cash management, accounting, statements going out to investors, and all that other stuff. Audit and tax reporting, that's going to be done in most cases when you have institutional investors, depending on how it's set up and, what your investor type is coming in. Most syndications, people are okay with avoiding the audit part, especially on ground up, where there really is no valuation for a ground up if you're 1 year in and say you just broke ground. So to kind of, for lack of a better term, waste money on that, there's kind of ways around that. But tax, of course, I think everyone knows the tax man is going to get paid regardless. So you have to make sure that that's ready. And of course, when you deal with multiple projects, having a fund admin is great because they work directly with your tax group and your auditor, and they're able to get them reporting in a timely manner. Because, I mean, I know everyone's busy, especially if you're running all these different projects, and to be able to keep all of those documents in line it's tough. Of course, here's my pitch for fund accounting and administration. I will never, shy away from it. I've seen some bad ones and I've seen some good ones. Your NAV is everything, and your ability to return, calls to your investors and make sure that they're kept up on everything is huge. You can do this in-house. I think a lot of people do, but I also see a lot of issues dealing with compliance and a few other factors in there that would make it seem a little more shady. I mean, if you deal with one person and you get you send someone 500,000 and they're dealing in 10 different projects, how do you know that it's being allocated correctly? That's kind of where I like the fund admins come in and be able to track everything. Of course, there's ways to kind of go about doing some nefarious deeds in there, no matter what. But it's helpful if you have someone good on your team. Audit and financial statements, I mean, these are just kind of some key dates, things like that to make sure. And this is great for anything if you're doing a standalone or group where audit planning starts, about right now. Actually, you're probably a little late if you haven't, especially if you're in a fund. The bigger groups like RSM, KPMG, Ernst & Young, all those groups, they book out months in advance. So you want to make sure that you get in there early so that you know that your docs are coming around. If you're running a debt fund and you have 1099s, you have that out by the second week in March or third week of March. And then, of course, your K1s. So K1s are March. February is 1099s. But it's all things you have to keep in mind when you go for, to make your investors happy. And then this is just kind of our summary page. Tried to cut it as short as possible to make sure that we can get comments in. I hope I did good on time.
You did great. Thank you. That's it. I have questions.
Of course. This is the best part.
I laugh because I always have questions because that's the fun part. So you brought up several things. So when you have a one-off, you know what's going on with it. You can see all the numbers, you know how it's running. But so there's a fund that just reported that they raised $5 million and they bought 85 properties with it. That's all it said. That's not a report to me. What did they buy? How much did they pay for it? What made it so that it was going to be profitable? They absolutely reported nothing. Aren't they supposed to report what they're buying and how it's going to be profitable to the investors?
So yes and no. I mean, you have to remember that, accounting and operations can get expensive. And, it depends on how much time people want to put in. I mean, depending on where you're working and the way they want to, disclose this information, of course, you want to know the 85 properties that you are invested in. I mean, I think everyone does. And that's kind of where, when you work on a bigger fund and have an audit, the auditors, if it's definitely GAAP, if GAAP compliant, they have to list everything out. They have to tell you the properties. They have to tell you all that stuff. And that's kind of, one of the pros of having those extra layers in there, of having a fund admin and having an administrator or an audit firm, a reputable audit firm. I mean, I can go into stories about audit firms all day long about people who, if you go to that, your cousin up the street, they'll write whatever you want. But having those connections and having those groups to work with, they'll make sure that you're in compliance. And if you're reporting in GAAP, you have to have a list of, level 1, 2, and 3 securities. Where, of course, most real estate is going to be level 3 because you can't accurately, price market to market the value of the property at any time. You'll have to go out and get a third party, but everything would be listed out. Your holdings report is on your balance sheet. Your balance sheet will be there. It'll say, maybe it just says properties, say $500,000, but there's usually a summary tab that will have everything listed out. Now, if I was the manager of the property and I'm spending that much of your money to invest, I would list them out and I'd have a quarterly letter or a monthly letter that comes out and say that. But of course, that's me knowing what investors want compared to caring enough as a fund manager to let me know that.
Okay, could you stop sharing your screen so we could all see each other, please? We didn't get any of that. All we got was that they spent $5 million buying 85 doors. They didn't tell us anything about it. They didn't tell us what the properties were, where they were, what the 85 doors were. To me, look, what you're saying is, yeah, it's a blind fund. They just go invest in whatever they want. They're not reporting back to the investors. We all want them to save money, but they should have, don't they have somebody in-house that takes care of the accounting? You keep talking audits are expensive, but all you need is somebody that reports back to the people what the expectations are, particularly when they say they're paying a certain cash flow and they're not meeting those numbers.
So I've seen a lot in my days, and I've heard of a lot of investors and a lot of money managers who do that. And of course it's detrimental because, when you give someone $5 million, you expect to see something come of it. And again, working with cash flow, it gets very difficult. Now, if you're running a debt fund, it's slightly different than running a blind pool where you're playing cash flows based on rental rolls and all this other stuff. And to kind of dispel the rumor, audits are expensive to some extent, but if you're raising $5 million, your audit might cost between $15,000 to $20,000. And one thing that most managers, I've noticed in the real estate space more than anyone else, they don't like to ding their investors with these payments. Now, I come from the hedge industry where everything runs through fund fees, not even the management fee. 2 and 20 has always been the hedge fund way. And the fund fees, like fund admin and audit, should come out of your profits. That's, it's kind of a write-off on your losses, to kind of offset everything, and it's charged back to the investor. So you yourself should be paying for these services so they can stay above board. So that way, internal accounting, very expensive, depending on the way you're set up. Of course, I'm always open to that conversation. If someone's like, hey, it's really expensive, I have a way where it's 50 basis points off your 2%, if that's what you plan on raising. I know someone who does it. They do all operations. There's a group that I've worked with. They're amazing at it. So you literally give them the money. They handle all the transactions. They spit out a report from you, and you get it. So there's ways around that. I think people like that anonymity that comes with it to some extent, but it's kind of dishonest as you raise money from investors because these people should know. Now, granted, Peggy, we've spoken a few times. I know you're very thorough. So, of course, I would say, honestly, you're probably in the top 5% of people who ask questions, where I would say a good 80% do not. And they're just like, okay, as long as I get my money, I don't see anything, I don't say anything, and they're just going on with their day.
That's why we're here, to protect the investor before they say yes. Mm-hmm. Cliff's got a question or two.
I've got a couple of questions. Yep. So how do we verify the quality of the fund and the individual aspects in the fund's performance?
The biggest thing will be track record. And I think that's what everyone says.
Well, with track record, that could be kind of subjective because if you just go off a track record, you're going to have some of the assets in the fund that may perform very well and other assets that are big losers. And then in essence, I would feel like the fund would be gambling with my money. So how would I be able to verify the quality of the performance for each asset in the fund?
See, that comes down to the amount of information that the manager wants to give up. If you're working with third parties in all aspects, you should have all that stuff written up. I'm working with one startup now that just signed on with RSM, which is, I think they're in the top 5. I think they're one of the biggest mid-sized audit firms in the U.S. And we worked through a deal where it is a little expensive, but they're going to do a study on each individual property that they're investing in. So they'll have that ability. So when you go to them and say, hey, here's my 100,000, what do you plan on doing? They will have all 5 properties that they invest in broken out. Now, can I say that about all of them? Definitely not. Can I say it's a lot of due diligence and probably more than, it's stuff that, I'm still learning. I mean, I wish I could tell you if I met someone I knew they were good or not from the first 5 seconds, but, it depends on and by track record, I don't just mean the way the fund's moving. I mean, the underlying construction companies that may be working on it, or the underlying management companies that handle these investments. Because if you're looking at cash flow and it's already stabilized property, you want to make sure the management company is not lying about capacity or vacancy rates. So, if we all know the area is going to be 5% and they're pulling, 2%, it seems they must be lying to some extent. I mean, I would definitely, discount that a little bit, but it really comes down to checking the underlying management. And of course, people don't want to give that up. I don't know why. I think there's enough business to go around, but you have to dig down as deep as you can. And if they don't give it to you, it could be a red flag.
That's exactly what I was thinking. I mean, because that's information we really should have as an investor. And if we're asking for that and it's they're dancing around it or just, flat out refuse to provide it, that would be a huge red flag for me. And I would not send my investors that way.
Right. We should be able to look at the income and the expenses, the actuals, and what their performance they expect it to be, so we can see if it's realistic. And if we ask for the rent rolls, we should be given the rent rolls also. The rent rolls will verify whether they have vacancies or not, or how many, and the rent roll will show how many people have given notice that they're leaving, and will also show all the new applications. It'll show who hasn't paid and for how long they haven't paid. I mean, the rent roll is a huge information to have when you're vetting out a deal.
And I imagine, Ryan, probably a lot of your retail investors are not going to ask questions like that. But, and I'll look at things differently. Peggy does too, because we both vet the opportunities before we present it to our investors to make sure that we're protecting their best interests, because we build long-term relationships with the people that we work with. So we might be in that upper 5% of that you stated earlier. But that's why we ask those questions. And, historically, I've just heard, stories where, both funds and REITs, they really didn't have the expertise necessary going into the type of asset class that they went into, and they were catering more to the investors than they were to the actual work itself, and it did not do well.
Right, and that's always going to be, I think that's the crux to any investment, regardless if it's a syndication or a fund. There's going to be those questions that have to be answered. And the funny part is, just to kind of piggyback off that a little bit, I was speaking with one of my friends who's looking to buy a SaaS business. And, they gave him the income and expense sheet. And then at the bottom, it said stock sale, not asset sale. But they didn't give the balance sheet at all. So it's like they want a cash offer. They didn't give the balance sheet. So how many liabilities could be on that balance sheet that I don't know about? So, and now it's been a day. We haven't received the trial balance or the balance sheet yet. And you kind of start kicking around like, well, are they trying to hide something? Or are they, but that's where a fund administrator, and especially the operations team, it's called Fund Views Capital LLC. That's the group that I work with. This guy's name is Greg Probst down in Florida. He has this pretty neat setup down there for it's called the Series LLC. So if you're raising for one almost like a syndication, it's actually a pretty good process and it's fairly cheap to do. But he handles all those cash transactions. So if there's a cash transaction that comes through, it hits your accountant and you'll be able to see all those movements. And that's an extra layer in there that you're hoping for, that when when you go into this, I mean, anybody can raise money, which is the scary part. I mean, there's no test to raising money. There's no test to running these funds. I mean, the scary part is even hedge funds you don't need a series license or anything like that, except in futures, options, and a few other, one-offs. But you're trusting people with this money. You have to make sure that there's a process in place, one, to make sure they're not just spending your money woefully. You have to make sure that what they're investing in is physically there. And you have to make sure if there is any cash flows that they're justified. And that's regardless of asset class. I mean, you can invest in a company. You give me $100,000, you can invest in Cardinal Financial Consulting, and I can actually drive a really nice car in $100,000 for about 6 months. So, there's ways around it. You hope that people are honest, but you have to be diligent, especially when you're building these relationships with investors and it's not just your money. Because, and this is, this goes personal. Like, I had to I coach a football team. I had to cut one of my 10-year-olds. It's like, you have those hard conversations and you have to go through things like that, but you have to be open and honest with them. And it's like, listen, work at it. You can come back next year. It's something you need to have in this business, especially in fund management, to make sure that they're giving you the true answer. And even though it could be bad, then yeah, come invest with me. I've invested in 6 properties. 5 of them went down, but the one was a huge home run. You'd be more apt to invest with me with that than me showing you 50% returns because I'm honest with you. But that's, that's going to be the huge hurdle you have in any type of blind pool.
Okay, thank you for that. How do we know how profitable a fund really is?
So, I mean, if you want to lie, just give them numbers, right? That's always the, especially in real estate, you're going to go off that normal, 20 plus IRR, 2 to 3 times multiple is kind of, I guess, the standard, at least in my mind, when people start talking about investing in, especially ground up, things like that. What are you looking at, say, maybe 6 to 8 to 10% cash flow on stabilized properties? Anything better than that is usually good, but the question comes down to, who's a part of the process. Like, if you're giving me your money, I'm going to make sure that I have the builder, the management company in place, and I can show you that. So that's something as a fund manager, they should be able to provide for you to make sure you go in there. And trust me, there's no problem if you can do it all, but the good chance is you can. So if you're a builder, there's a good chance you're not a management company. Or if you do, you're segregated enough where you're not, keeping that pool together. So you have a management company spun off from you. Those are probably the people I like the best because they plan the process out. And if they have, say, 5-year track record of building, renting, and managing, then it's a pretty good, assumption that they have the process down. They can build for a certain amount of door. They can rent it within, say, 6 to 18 months. And then they've been running those properties for 3 years. I don't think you can go wrong with that kind of track record. But again, that's something that they should be telling you.
Well, you are a partner, and don't you have documentation that shows you what your partnership holding is? And then they have the audits, and you get to see what exactly the profit is with the company, and you know what the split is.
Right, and that's as long as they pay for it. And they make sure that they want to give you that comfort. There's no guarantee that they're going to provide it to you, but they should. There's
no guarantee they're going to provide the financials to us? Isn't that in the PPM that they will?
Sometimes. It depends on if you read the whole PPM, depending on the PPM, of course. I try to make sure that people, the reporting requirements, I like, and this is of course just personal, but I like to keep people to hedge fund requirements, which is going a little overboard because the SEC is so big on, how hedge funds run. So my goal is, and of course tax and audit people hate this because it overlaps in deliveries, so I don't really care about that. But, they make sure that they get all your documents out by March 15th so that you're ready for April 15th for your personal taxes, and they give you all that information, which means audited financials would be on your desk March 15th. Your tax documents would be ready March 15th, and then you'd be able to see what happens. My usual, my usual request to the managers that I've been working with is I want monthly communications, but I'm okay with quarterly. And I will tell people to write their PPM quarterly and just kind of, what is it, under promise, over deliver. Because, if people really want to know, they need to communicate with you regularly. And the best way to do that is, say, a monthly newsletter compared to, Peggy calling once a month to see where everything's at. You want to be open and honest. Of course, in this business, I don't know the exact rate of, good to bad, but, as long as you keep communicating, everything should be fine.
Yeah, it's not always the good to bad, it's the lack of experience. And like you're talking about, these people starting a new fund or starting a fund and they're brand new. Who's going to invest with somebody that hasn't brought in some experienced people? The key is the experience. And if you want to do a fund or even a one-off, you need to have experienced people. Otherwise, people are not going to invest. It puts that people that aren't experienced put all their investors at risk. People that are well experienced, there's still risk.
Right.
And the people with experience will get the situation corrected. It may take time, but it will happen. Whereas an inexperienced person, you might lose everything because they don't know what to do. They don't know about the 100 different ways to put a deal together, or that they're supposed to make the profit going in. I don't know who's teaching these days, but they're not teaching that. Ted.
No, that's true. And that's part of the reason why I spun off and created my consulting firm, because, I like to get that accounting and operations and kind of from day one to make sure that the infrastructure is in place, that, the true people that I can work with can make sure that, there's proof and there's I guess it's a responsibility to the investors, and make sure that, there's a lot that people go through. I mean, anybody could start a fund. Anybody can call up one of those, I think it's a SURE or something like that, and say, hey, I want to raise $5 million for this property. And of course, they'll open it for you, and they'll say they're doing this on the back end, and they have this wonderful, platform that files your blue sky for you and all this other stuff. But, there's no one there to tell you if you're doing it right or wrong, or there's nowhere there to tell you, maybe you should communicate with your investors. And that's kind of why I stepped in and kind of helped out people along the way to make sure that they're focusing on the investment part. But when they come to me, they realize, that, hey, there's management fees, hey, there's this, there's that. They want to make sure that, there's a flow going on where they don't have to focus 100% of the time.
Thank you. Ted has a question.
I'm trying to, let's say get my head around the difference between a fund and investing in individual properties, which I think is more Peggy's and Cliff's strategy, because I know the two of them. I know, Ryan, Ryan, what do you say to let's say an investor about which would be a preferable investment strategy, a fund or individual investments, individual property investments, and why?
So it really comes down to your risk tolerance, and it comes down to, what you want to do. I mean, yes, if you invest in 10 different syndications, you'll have the same diversity as if you invested in one fund that has 10 investments. Of course, you're kind of, taking a little more risk knowing that there's one manager who's handling all that. Now, my thing is, I like to look for niches if I'm going into a fund where I know someone's proven in the area, and that's where they're going to focus. I don't like investing in, I'm not going to blast this or anything, but I think Cardone Capital will be like, hey, we have one property in Texas, one property in Florida, one property in so-and-so. I don't have the time or the due diligence to kind of look into what they're actually doing. But if I'm looking across 3 different areas, that kind of raises a flag for me. I like, if I'm going to invest in a fund, I want them to be specific in the same asset class and probably a short amount of projects. I don't trust someone who comes to me and goes, hey, I got a deal for you in Texas. Hey, I got a deal for you in Florida. Hey, I got a deal for you in California. Those are 3 different places. And if that's a builder, there's 3 different rules that you have to go by. And how can you be sure that that construction guy knows the rules in each one of those areas? Or has he just built one house and he's like, let me try multifamily out. Let me raise money from you. Yeah, I made 60% on my last deal, but that was a single family home in Nova Scotia. And now they're down in the US and he's going through 3 different locations and he just spoils the money. Funds are great, especially if you find the right fund managers to be able to invest in them. It's the same level of due diligence. You're going to go through it if they have 1 property or 5 properties. You just have to make sure that, that's kind of the direction you want to go in. If that answers your question or just opens up more questions, I'm not sure.
Well, to some extent, it opens up more questions because it seems to me that essentially we're turning real estate investing, let's say, into the equivalent of the securities markets when we're because if we would equate it to something, let's say, like an athletic team example, if we're going to invest in individual properties, we become essentially the equivalent of the coach watching the players or minding the players. And if we're going to invest in more than one activity, we got to watch a whole bunch of different teams, a whole bunch of different players. If we invest in a fund, we can be more like a fan, essentially, whereas we are essentially paying somebody else to do that let's say that lower level management. How much management, how much due diligence do we want to do as investors? And to some extent, that's the role the auditor plays, is to make sure that the whoever is reporting to us as the investors is actually telling us the truth. If we could trust let's say the business operators to tell us the truth without any oversight, we wouldn't need auditors. Unfortunately, human beings tend unfortunately not to be as trustworthy as we'd like. That's where the auditor plays a role.
That's why the experience is important. Thank you, Ted. Cliff, question, comment?
Yes. So Ryan, when you're working with somebody that's over 60 years of age, there's some restrictions for what percentage of money that you can have in any one single investment. With a hedge fund, because you have several different things that are under the hood with that hedge fund typically, are those restrictions lifted?
I have to look into that. I don't believe so, because it depends on which way the SEC wants to look through. Because anytime dealing with them with hedge funds, it's a pool, and depending on how they want to spread their assets, there is sometimes concentrations, and I know they'll do that with your ERISA filings and all that other stuff to make sure everything's in line. In real estate, I know a lot of people try to avoid that. I don't know. I don't think depending on the size of the funds, it could be a non-issue. Because if you start a small enough fund and the money's not high enough to be reviewed, no one's going to say anything. Then it comes down to you as a manager making sure that, you're doing your due diligence, and it's kind of that know your client, where, if you're bringing someone in at that age, should they be investing in this? If, depending on the risk profile and kind of how they plan on investing in the funds, that it could have an issue, but I don't think it would.
At what revenue level would that be considered flagged for review?
I'm not sure. I'll look into it and I'll get.
Okay. And with your fund, accredited, sophisticated, both?
For which one?
For your fund, do you have to be accredited to actually deploy funds into your fund?
Yes. Most
Okay.
of the time, most of the funds I work with, everyone is accredited. Occasionally I'll see a 506C come across, or a 506B. Trying to remember which one. I always get those two mixed
B is
up.
for sophisticated.
Yeah. So I see them both often. Occasionally, I mean, I know one Reg A that's in the real estate space that I helped launch. Crowdfunding, I tend to stay away from. I don't know about you guys and your thoughts on that. I feel like there's a lot more, for lack of a better term, scams in that area, especially due to the rules of how to raise and how little it is. If there's overruns, it seems like it's set up for failure in my mind. I mean, I'm all for getting non-accredited investors into the game. That's kind of one of my bigger pushes, and I pitch anybody Reg A that comes across because I like that opportunity. Like Vint.com, they do spirits and wine. They buy up, They buy up crates, and they spin them off into each individual kind of sub-series, and they hold them for 3 to 5 years, and then they sell them, and they open them up, and it's a pretty cool idea. I run one that's a promissory note. It's a one-for-one promissory note. So if you invest in promissory, you come through the Reg A, you invest in a promissory note, and it's steady income over the period. Reg A in terms of buildings and ground-up construction, again, I'm a little worried to get involved in. There is a way you can pool capital for Reg A. I don't know it. I know someone reached out to me to have a conversation with that. We never did. I think it has something to do with spinning off series. But again, I mean, there's limits of 20 million and 75 million. And trying to get those at, say, $500 a share, it takes a lot to get that going. You need to have a really solid marketing plan to get those up and running. So, I mean, it's mostly accredited, but, I'm always open to help people out start something for non-accredited investors.
Okay, thank you.
Thank you. So we are at the top of the hour. This has been a very lovely presentation. Thank you very much, Ryan. I do have one question for the audience, and that is, if any of you have ever invested in a fund or have your own fund, is there anything that you think an investor, before they invest, ought to look at, have on their list? I'm making a list, so you're talking to me.
Douglas Dowell's got his hand up.
My first advice is to work with Ryan.
Okay, good.
Yeah,
Look at these because
we
they
are working
kill you
with
on
Ryan.
P, just so
Yeah,
you guys know. So,
yeah.
like, if you look at your REITs, that's why I stopped investing in REITs. And I went to the board meeting one year and I asked what was the $2 million other, and nobody on the board could explain it. I pulled my money all out that day.
Ooh.
Good for you.
REITs are dangerous. Even though they say 90% of income should be distributed, there's a lot of hidden fees in there and I'm pretty sure that's probably where your other came from. They can charge 5 to 10% on a deal, and it's written somewhere in one of the documents far down. It's not a way to steal money, but I'm
No,
sure they
it's
could
still
charge
money
it.
because the fund
It's
made
stealing money.
34%, but they would pay out 9%. It was a ripoff.
Yeah, it's called theft.
Total ripoff. They had so many junk fees in there that they couldn't even explain them after. Like, everybody was laughing at the board, so I wasn't laughing.
I bet you weren't, Chris. Steve.
Well done, Ryan. Great. I kind of fall in the camp of the individual deal rather than a fund that has multiple deals for the same reasons that Peggy brought up. How do you know what's really going on with each property? So my advice for investors, and I'm not a hugely experienced operator. I usually just invest my own money. I want to make sure that the money that's going into the property is secured and protected, either with the real estate or enough equity in it, that cushion, so that if something does go wrong, that there's a way out. So I then tend to look more at the individual property rather than a fund, because it's easier to understand if that's happening.
And you always have to have a way out or two. We have people that will not close on a deal unless they have at least two exits. Just smart. So we are now, any other questions, Steve? Or a comment?
No, thank you. That was good.
Great. So thank you very much, everyone, for coming. Ryan, this was a great presentation. We really appreciate you coming, and we hope you will come back again.
Of course. Thank you so much, Peggy. Thanks everyone for attending. It was a good time. Sorry my camera didn't work. I'll be on next time.
Okay.